Now we will see, we have seen the how the growth and farm value linked with each other. If the company is having good investment opportunity, it should retain more and reinvest in the company. Then the farm value will increase. Here is the information given for Starbucks stock price during period of growth at above and below its SGR. So the growth above its sustainable growth rate you can see here, stock price and the year. When the company is growing above the SGR, the price was increasing, and when the company was growing only at the SGR, price was falling. And below the sustainable growth rate, again the company started paying dividend and the stock price started peaking. So this is the way companies make the dividend policy. Now we will see the valuing the expansion. So we will see forecasting the free cash flow. Now we have calculated net income, we have calculated shareholder equity, changes in net working capital, the interest tax shield. Then we can comfortably calculate the free cash flow, isn't it? We know when it is free cash flow, the starting point is net income. So first we calculate forecasted free cash flow as follows. Number one, start with net income. Whenever you are talking about free cash flow, blindly start with net income. Then, as I was telling you, the next adjustment will be interest. Add the tax shield from the interest expenses. Then add back the depreciation. Then deduct the changes in net working capital. Then deduct the additional capital spending. So these are the adjustments we will do to get the free cash flow. Let us do it. Net income of the company we have projected in the previous slide, 7600, 8807, like that up to 2021. What we have seen, number one is add the after tax interest expenses. That means interest minus interest tax shield is equal to after tax interest expenses. Interest minus interest tax shield. As I told you, the same point only that it will be done later on here. Interest minus interest tax shield. The interest is minus 306. 306 multiplied by the tax. You know ITS formula we have done in a previous chapter, that interest tax shield ITS is equal to the interest multiplied by rate of income tax. Once you do that, you get the interest tax shield. Deduct that from interest. Then you will get the after tax interest expenses, which it is being done here. After tax interest expenses. So net income added with after tax interest expenses will give you the unlevered net income. When you are taking capital budgeting, you should always take the unlevered income. Unlevered income means the income which is not adjusted by interest before that. That means the net income added with whatever deducted there in the net income. To get the net income, we deducted the interest. Now we added back here. In the income statement, we deducted the interest, right? There we deducted, we added here back. So we got the unlevered net income. Once we get the unlevered net income, the three popular adjustment. Finger count, three popular adjustment. What are they? Number one, add depreciation. Number two, deduct the changes in net working capital. Number three, deduct the capital expenditure. Do it here. Unlevered net income is given. 2017, 18, 19, 20, 21, we got the unlevered net income. Add the depreciation. Deduct the net working capital. Deduct the capital expenditure. You will get the free cash flow. Once you get the free cash flow, just use the enterprise value, that is EBITDA horizon multiplied by EBITDA multiple, will give you the terminal value. Add back that with the present value of the free cash flows. So here free cash flow we calculated, simply free cash flow we calculated here 15,015,3586,5320, that's the free cash flow. Start from there. 15,015,3586,5320, that is the free cash flow. Calculate the free cash flow at 10% given in the above. Our WACC is 10%. Therefore, present value of free cash flows at 10%. Calculate, that is the free cash flow of 15,015, that 3586,5320,7250 is equal to 4096. Terminal value is equal to the 2021 free cash flow multiplied with the EBITDA multiple, given here EBITDA multiple. Then it gives you the terminal value. That terminal value, present value at 10%. 313,920 is the terminal value at 2021. What is the present value today? 194,920. Net interest expenses minus, because interest you have added back to get the unlevered income, right? Deduct again here, minus 306, 1666, as per the interest is deducted. Interest tax shield, interest minus interest tax shield is equal to the net interest we added there, again deducted here. Present value of tax shield at 6.8%, 1958. 6.8% is the bond interest rate, huh? So 1958 is the present value of interest tax shield. Farm value is equal to 4096 plus 194.90 plus 1958 is equal to 200,974. That is the value of the company. And if you are not considering the expansion, then the company's production will be 1,000, 1,100, 1,100, 1,100, 1,100, and same 10% growth, then it will continue forever. Sales price, sales revenue, another permutation is, another kind of adjustment is being done here. If you are doing expansion, your farm value is 200,974. If you are not expanding, your farm value is 142,686. Without expansion, farm value 142,686. With expansion, farm value 200,974. So because of the expansion, the company could make a 60 million extra cash flow because of the expansion. So the company should go for expansion. So this is the way the pro forma balance sheet, taking all the different slides data put together here. Balance sheet, asset side, liability side, equity side, all put together. Then the balance sheet from 2016 to 2021. Just a minute.